Hello, everybody. It is 10:41 at night. Steven decided that he wanted to nerd out about some Palantir earnings with me and Chris. And he said, if you want to hop on a Zoom, we'll hop on a Zoom. We hopped on a Zoom. And as soon as we hopped on a Zoom, I said, Steven, this will now be a recorded podcast and you are here held and you cannot leave until you educate us about what happened in Palantir. So Steven, as you guys all know him from 2 weeks ago, educated us very deeply on Palantir's free cash flow. And he's going to do the same today on Q3 earnings. So before we get into the numbers, all that stuff, Chris, everyone already heard your thoughts because you're a prominent figure in the Palantir community. Everyone knows about you. Steven, before we get into the numbers, like 3 minute summary, Palantir Q3 earnings, good, bad. How did you feel once you saw it?
Yeah, so once again, this is my own personal opinion. Please do your own research. I do not know your situation. Just because I like Palantir for the long term and am a shareholder does not mean it is a good investment for anybody else. So please do your due diligence. This is not financial advice. This is just an opinion. So the real quick version before we get into it is mixed emotions. I was not happy at the beginning. After I really sat down and looked through, I looked through it 2 times after I got home from the office. Re-listened to the earnings call, looked at all the numbers. I had to change my investment thesis because the numbers have changed. So the free cash flow that is on YouTube from 2 weeks ago is no longer my summary. It has changed. The big thing is Palantir's revenue growth is slowed, and we don't have enough data to see if this is an anomaly year or if this is the new trend. Their margins are horrible right now. Maybe horrible is a little bit of a strong word, but compared to where we were last year and compared to 2021, they're not good. They're throwing off less cash from operations. Their free cash flow is less. And they're in the mid to high single digits for free cash flow. I'm not going by adjusted free cash flow. I hate adjusted numbers. I'm looking at strict free cash flow, cash from operations minus CapEx, which is property and equipment for Palantir. 7-point-something percent, 7.7 or 7.8%, I think. I'm not looking at it right now. But it made me change the thesis, and I built 2 new models, and I need 3 more quarters of data to make up my final decision. I am probably going to buy more and dollar cost average. They are in a very good position given there's no debt in a rising rate environment. They got $2.4 billion in cash. That's great, but the thesis has changed. The one thing that I think people overlooked, and I said it before and I'll say it again, I hate that Alex Karp puts the cohort growth in the shareholder letter, not the earnings report. It is so important, and they are absolutely killing it on new customers. And I am hoping that that could drive net dollar retention. We're stuck at 119% into Q2 and Q3. But Chris hit it on the head with their marketing, and the Foundry Con was so important because how many times do you see a conference around a software platform and you have BP, Morgan Stanley, Apache, Merck, BMW, Hertz, all these companies go and present, Jacobs, and show what implementing Palantir has done for their companies? It's just, I'm torn because I see the road and I see a way to get there, but Q3 really threw a lot of water on that fire because of the margins and the decelerating growth. So that's my take. I'm kind of mixed right now. Neutral, not bullish, but I could become a bull again next quarter or two. Guys.
But Steven, when you really take a step back, right? And when we look at this a little bit closer, we should remember that the macro environment right now is not built for discretionary spending, okay? Every company right now is probably trying to figure out where they can do the biggest cost-cutting measures possible. Most of them are looking at personnel reductions. Some of them are closely looking at some of the products that they've got within the last year or two, and they've pretty much shut the doors on any new products coming in that are going to require a ton of human capital as well as actual physical capital. So Palantir just has a very challenging environment. That's not just Palantir. I think there's a lot of companies that in this space are going to be in a challenging position until we return back to growth. And all these companies have to figure out ways that they can differentiate themselves from their competitors. Right now, their competitors are bleeding and so are they. So their whole logic is, you know what? If it ain't broke, don't fix it. Figure out where we can cut back on the balance sheet. And they're going to see line items that are coming from Palantir. And those line items are in the millions, right? When it comes to things like Snowflake and Tableau and all these other things, these are small service contracts, usage based. They can cut those down at any time. But Palantir, because of the way that they structure their deals, these are large contracts, right? So in order for any
They're
company,
huge. They're not
yeah,
going after small
yeah,
caps or even mid caps. They're huge. I mean, you
yeah,
look at, I know exactly what slide you're talking about.
yeah.
It's impressive.
Now, one of the things that I wasn't a big fan of, to be honest with you, is when they kept saying net. Did you see that? Net customer ads, net customer ads? Now, when you say net customer ads, that means that there's probably some that left or some that decided not to go with you, right? Which
What do you
is
mean?
something.
Why is that the case?
So when you think about it, if I say we had 33 customer additions, right, versus we had 33 net customer additions, what do you think the net means? That means that you gained 33, but you may have lost 3 or 4 or 5 or 6, whatever, because you may have gained actually 38, but you might have actually lost 3 or 4. Right now is not the environment where you want to be losing customers, right? Like I said, it's just something that I picked up when they kept saying net. So just,
Well, that's why I hate net revenue, net this, just like you, net that. I don't like it. I don't like adjusted numbers. I want to see just the zeroed out number.
yeah,
Like,
exactly.
look, you're talking about, I don't know what slide it is because they didn't number it. It's in the it's a appendix A, I think. 78 deals of at least $1 million, 32 of 5 million, and 19 at least 10 million. I mean, these are big deals.
Yeah.
Regular companies are not spending that on software. Doesn't matter if it's in the ERP system where your HR and finance is, or any type of other foundational software. These are big numbers. These are the biggest companies. And we know that they did a deal with Exxon. We know that they did a deal with Kinder Morgan last quarter or the quarter before. These are big industrial companies, conglomerates.
So
And
here,
something I wanted you to discuss real quick, if you could, if you didn't mind. They had somebody from Jacobs, and you brought up something in a previous segment, and this goes back when you talked about Bechtel and how important that relationship is. When I saw what they did with Jacobs, and you look what they're doing with Hyundai Heavy, there is a real road where they can create foundational platforms that are proprietary to those industries, just like they do with Airbus and Skywise. I mean, it's huge. If you could touch on what you think about that, that's what I'm interested in with the Jacobs situation.
I think it's good, but it's kind of risky, to be honest with you, because when you're trying to create like industry-wide platforms, that means that you've picked a partner that's going to kind of like help you do that. But then there's other companies that may or may not want to be in the same kind of a business relationship, right? So here's an example. Palantir hasn't really done a great job of joint ventures. Like they've had a bunch of joint venture blowups in the past that aren't really like put out there. Like here's an example, Credit Suisse. They actually invested their own capital, and Credit Suisse put money together in a product that I think it was called Signac, and it completely failed. Like it was bad. It was really bad to the point where people were actually fired over it. They had to take a huge write down on it. This was before they went IPO, right? So this whole idea of doing joint ventures, it's high rewards, but it's also kind of risky too, because you have to be careful of which counterparties you're getting involved with, because those counterparties have to have a material execution to make the product successful. So even if, let's say right now, if they're trying to go that route where they're working with individual counterparties and then creating value, I'm not so sure that the other industry players may or may not adopt that whole thing. I think from a regulatory framework, if they're able to help capitalize like the Jacobs deal, I think that could definitely work. But the joint venture way of doing things in the past, I'm not a big fan of. Like I would rather them do more in line with something of a SaaS model where they're just literally selling services and just doing an outright deal rather than trying to generate some sort of exponential return via a joint venture partnership. For every one Airbus partnership that they've had others that have gone down, like Home Depot. That didn't work out very well. They had like a cybersecurity platform deal with them at one point. Then
but
there
Chris,
was,
I see what you're saying, but don't you think that's the bull case for Palantir? That they create these transformational, generational platforms that permeate throughout industries? Like, if it's just a SaaS business, why are we so excited, right? It's the idea that Skywise like can go to 10 different industries, right? That's like why we're excited, right?
Well, the thing is, Skywise is an industrial player that feeds into other things. But if you take a look at it, there's only two major aircraft manufacturers. I mean, there's more, but there's two major ones. There's Boeing and Airbus, right? So when they developed this joint partnership with Airbus, all the other companies, the airlines that use their products ended up getting monitoring services. Like an example of something that I think would be very like really well is something like Siemens or GE. If they partner with Siemens or GE, what happens is there's all these other companies that use Siemens and GE products, whether it be their healthcare products, their energy and power production products. All of those things would be perfect for joint ventures. For some of these other things, I'm not so sure. Like Hyundai Heavy, I think will do exceptionally well. Hyundai Heavy is not just Hyundai itself, but it's also the conglomerate that's underneath it, whether it's shipbuilding and that. Yeah. So when it comes down to it, if you think about it, if you buy a ship from Hyundai Heavy, guess what? If it's got Palantir already integrated, you won't mind working with Palantir / Hyundai Heavy. So Hyundai Heavy is going to sell the services, but you're almost reliant on your business partner in order to make that sale for you. Like Airbus took a very strong, we're going to work with you no matter what approach. And that relationship ended up doing really well. The question is, how is that going to translate into profitability for Palantir in the future?
So Chris, did you sell puts today?
I did not. No, I sold some covered calls.
You're still in.
I sold covered calls. Yeah, I sold some covered calls.
Oh, so you already picked an exit number.
I didn't pick an exit number per se. I just wanted to generate a little bit of return so that this way I could use it to buy more. So I sold $8 calls because the implied volatility was out of this world a couple of days ago. And you guys know, there's no secret on the weekly call. I even said, don't expect radical movements because with good numbers, companies have taken a beating. With bad numbers, companies have taken a beating. So there was no way that I saw Palantir coming up with such exceptional numbers that would have skyrocketed it to like $10. So at that time, I was just like,
look at Apple.
Yeah.
Apple generated $99.8 billion. Billion.
Yeah.
The most ever from any company I know of, other than maybe Saudi Aramco.
Yeah.
They were down 11.8% as of, I think, yesterday from their earnings on the 28th of October. If they're not going to rally off of 99.8 billion of net income, it's going to be hard for any company to rally in this environment.
Exactly.
And quite honestly, I don't know that the market really bottoms until Apple bottoms. Apple's 6 or 7% of S&P. And dollars are dollars, and they are the largest generator of net income.
Yeah, the barometer
I
was going to say the barometer that I looked at was Alteryx. Alteryx is in a very similar business of providing analytical services and AI and machine learning capabilities to Palantir. So I looked at them, and they reported early last week. They knocked it out of the park in all their segments. They did exceptionally well. Yet on Friday, they took a beating just like everybody else. So I'm sorry to interrupt. Amit, go ahead.
No, that makes sense. And ultimately, we're going to see how everything bottoms out and where the big players go. Steven, before we get nitty gritty to numbers, I wanted to ask you how you felt about Karp. You didn't like his performance last time, particularly his composure.
I think, Palantir, whoever from PR or whoever stepped in and changed up the format, I think they should go with this format every time. I wish the Q&A was longer, but
yeah, how did you feel about the weirdest question at the end? She was like, Alex, there have been a bunch of retail questions for you. Is there anything you would like to say? And I was like, what? You're not even going to ask one of the 2,000 questions on Robinhood? Like, that was insane to me. That was actually insane.
Retail out of it. Where were the analysts? Where were the analyst questions?
Yeah, there was like barely 2 that asked questions.
Where were all the questions? I'm used to I listen to a lot of earnings calls.
Okay, so given your experience in earnings calls, is there a legal requirement for a company to take?
I have no idea. No
But
clue.
it's common for them to take 5 or 6, right? Not 2.
If you go to Seeking Alpha or you go to any of these places where they do the transcripts, just scroll through any of the companies that have reported in the past 2 weeks. You're going to see a lot more questions from analysts than what we
Yeah.
got in the Palantir call. I
We
thought
got
that was
nothing.
weird. I thought it was weird.
Yeah, I thought it was weird as well. Okay. Numbers. So which ones do you want to start with? Maybe good first or bad first?
Let's do the customer count slide real quick. I mean, I don't know how coherent I'm really going to be for how much longer. I'm still wired on coffee, but yeah, we'll give it a whirl.
All right, I'll pull up that deck real quick.
Yeah, it's in the shareholder letter. It's such an important slide, and this is where I think the net dollar retention can really come into play next year and the year after.
Okay, so we got customer count, right?
No, get out of this. Go to Carp's shareholder letter for Q3.
Oh, that one, you're talking about that one.
Yeah.
Okay, gotcha.
He never puts this slide in the regular slide deck, which I think is a mistake.
That is
Because this
interesting.
tells the story.
I like the fact that they were actually pushing down market, which is nice because they had about 73 deals at the $1 million mark, so.
There it is. Can you blow that up? All right, so let's keep in mind, Palantir went public end of September 2020. And prior to going public, Chris, what was the stigma? Black box company, what was the stigma? That they are a military industrial complex company, that they only prioritize and only really specialize in platforms for special operations, JSAC, and the DoD. Is that somewhat of an accurate statement?
Yep.
Yeah.
Okay. So Q3 2020 is around where they went public, right at the end of it. With 12 new customers in the trailing 12 months in that period. Going forward in 2021, you had a 408% increase to 61 new customers on the TTM. Now, when you look at 2022, and this is where, and I mean, you and I had the conversation, I think, when we discussed SoFi, that when I look at numbers, it's a lot easier to grow when you're small from a percentage basis and have these amazing, really attractive percentage-based gains. But you can have a lower percentage-based gain, but still grow at a phenomenal rate and add even more customers. Look at the new customers in 2022. You have 134. You grew by 73 new customers compared to the 49 new customers year over year in Q3 TTM 2021. You still grew at 119.67%.
Yeah.
The amount of growth that this is setting up for. And while I wasn't thrilled with the revenue decline this quarter or the projection for 2022, when you annualize it based on the 1.91 that they said, this huge customer base, I mean, how many customers have they grown by? It's phenomenal. And it's setting up additional services. It's setting up the possibilities for additional revenue for add-ons on the contracts. And if they grow at a flat rate, if they don't add a single new customer, they grow at 134 next year, they're at, what is it, 471 customers, new customers since over the past 4 years, Obey. I mean, it's just, this is where, as much as I wanted to hate every aspect of the quarter and say they're on the road to not being where I thought my original projection would be, even though I had to make 2 models, and one of them is 2022 with an anomaly and 2022 on a decline going forward, this gives me hope that 2022 could be an anomaly because of the amount of new customers. And when you have companies like BP, Morgan Stanley, Tyson Foods, Jacobs, all these big name companies with strong testimonials, you're going to get the residual effects from other companies inviting you into that boardroom, inviting you to the RFP, and hearing what you have to say and seeing what you can do for them. And I just think that, I mean, Chris, you're in that business. That is really strong stuff where that was not known in Q3 2020. It just wasn't known. We're seeing the effects of Palantir being out there, more testimonials, and more people trusting because the results all these other conglomerates are saying they're achieving through Palantir software.
And like Snowflake having 6,000 customers, like that doesn't make you feel any type of way that even though Palantir only has 400.
I don't follow Snowflake.
So they're in a very differentiated market. Like Snowflake right now provides data warehousing services and cloud-based data wawarehousing services.
Chris
right?
has that line memorized. Snowflake provides data warehousing services and
I'll
cloud-based.
tell you why I don't follow them. I am a fan of Slootman. He's an amazing operator. I wanted to invest. On principle, I wouldn't invest because I hated the valuation when it absolutely popped because Berkshire and Benioff from Salesforce both came out a week before with positions in it. And the valuation has been sky high. So on principle, I wanted to, but if it comes down, I'll probably do some due diligence and look into it because it was a company I was very interested in, but I just never really looked into them after it just went sky high.
It's close to its IPO price right now. So just FYI, I just did a video on Snowflake actually, but let's go back to just Snowflake and Palantir, the comparison with that. First of all, it's much easier to get Snowflake on board. Okay. They have a pay as you go model. It's not as like in depth that you need like Palantir to be. Palantir will come, they'll actually send a forward deployed engineer. You know, it's not a plug and play thing that some people are expecting. Like, yes, technically it is something that's easily set. Like it's easier. It's really easy to set up, but it's not Snowflake. Snowflake is providing a service, like a platform as a service, whereas Palantir is providing actual like operational software, right? But it's customized operational software. So even though there is an argument that a lot of people make that Palantir is not a consultancy, at the end of the day, they're operating like a consultancy, whereas Snowflake is a traditional SaaS vendor. Now, here's the thing: consultancies, regardless how people feel about them, they still make really good money. Okay, so I would not put it past Palantir to be a successful consultancy company when it comes to helping businesses be more operational. Now, the one thing I did notice is that customer growth primarily probably came from smaller contracts. So even though in the past they might have shunned those smaller contracts, now they're trying to get every nibble that they can into their hands. Why? Because it's the same thing I said a year ago. Small companies become middle tier companies, become large, and large becomes mega, right? At the end of the day, you can't just say, well, we're only going to target the largest companies because those are the ones that need our help the most. No, everyone needs help. Everyone has money to spend, but they may not have a lot of money at their current stage of growth. So Palantir really is changing that whole model around. I think they have a much more mature product. They understand how to deploy it, and they've got better at scaling now. So now it's actually worthwhile in them getting these smaller clients, whereas before it might have been too unprofitable based on a whole myriad of factors. So I do think in an environment where we're starting to see growth kind of accelerate again, companies like Palantir will do well, but we're not there. And I don't know if we're going to be there for at least another 2 years, believe it or not. 1 year for the market to stabilize, another year that's a transition year where everyone is trying to figure things out, where everyone is still shaking the cobwebs off of the rust off of their businesses, and then you return to growth. This is probably so similar to the year 2000 where we had the giant tech bubble. It's
different. It's similar in some respects, but it's different. You had a lot of companies that weren't generating real revenue or
right.
So
now, what is that?
Companies got huge valuations on ideas because they were a website.
Yeah, but think about it. This time it was the same thing with all these SPACs, right? Where you had these magical SPACs. Yes, some of them actually generated revenue, but none of them were net income positive. Everyone was just burning cash. I would say that they're actually worse than the dot-com era, because at least the dot-com era weren't like burning through cash at
You
such a
think
rapid
Wejo is
pace.
worse than pets.com?
No, I'm just saying the ideas that this time around, like from a 10,000-foot view, were really nice. Dude, think about it. Palantir invested 25 million in that company Energy Vault. That literally is like the whole foundation behind
Hey,
it is,
I did a video on them. Okay, do not
I
talk shit
know.
about Energy Vault.
They said we are going to take concrete blocks and move them from one place to another and use that as battery storage. Like the physics didn't even make sense, but yet somehow Palantir and their AI algorithm was going to figure out how to change the laws of physics. Are you fucking kidding me right now? Like it just
Carp
whatever.
drank too much of the energy that they gave him.
Yeah, and that's the thing. There's so many companies out there at the time because capital was so cheap. People weren't observing things. Not going the traditional IPO route should be a warning sign to most investors. I hate to say this, but when you go through the roadshow, they're going to do like a detailed, like in the S1, you get a detailed proctology exam by every investment bank and most real investors out there. So right now, the SPACs, they didn't have to go through that process. They literally just had to get someone to sign off and says, here's the money. And that's it. So that's why if you look at it, about 80%, or I even like to say 90% of the SPACs are below their de-SPAC price. I think half of them are below $1, and I think 10% of them are already bankrupt, or on their last legs, because now their cash has basically run out. The cash runway is completely gone. All these guys, all these companies that help de-SPAC, they walked away with tons of money with their fees and their warrants that they sold on the open market. So I think this is very similar to the 2000 bubble, but I do think that there's probably a lot of opportunities in growth names that
Let's get into Steve's other numbers. So Steve, that was one number you liked. I'm assuming you're gonna give me a number you don't like now.
Yeah, I mean, the revenue and the margins, they're not good. I mean, look, you go back to Q2 2021, I think. I put it in, hold on, I put it in the article. So Q2 2021, their 2021 outlook was 300 million for adjusted free cash flow, which was 100% increase from the previous projection, but their revenue growth was supposed to be 30% plus for 2021 and for the next 4 consecutive years through 2025. That was their numbers, and that was the revenue projection that I had used for my model for 2022, 3, 4, and 5. And I used the 20.83% free cash flow margin from 2021. It's not the case anymore. So right now we are setting up for $1.9 billion of revenue in 2022. That is a growth rate year over year from where 2021 finished of 23.29%. I have no idea what their free cash flow is going to be. I am optimistic that it's going to be 190.1 million. That could change over the first 3 months. I should have labeled everything on my spreadsheet. Over the first 9 months of 2021, they had done 233 million.64 of free cash flow. We are only at 109.86 million right now for 2022 free cash flow year to date, first 9 months. So I think I'm being optimistic that they're going to hit a 10% margin because they're currently at 7.86. So at a 10 point margin, you're at 190 million free cash flow for the year. So now the question becomes, is 2022 an anomaly? And in 2023, do we get back to 30% that they previously projected? Or as Chris said, has the landscape completely changed? And that's not the case. So I had to build 2 models to kind of figure out where I'm sitting. And I can make a case where this is an anomaly. 23, 24, and 25 will both be at 30%. And then we scale down 25% in 2026, 22%, 19%, 17%, 15% into 2023 for year-over-year revenue growth. But if this is not an anomaly, that is very scary and it really changes the thesis, and everybody should really think about this. We come in at 23.29% this year as Palantir's projection. That is not my number, that's Palantir's number. Now, my speculation is if this is the best that it gets and growth still subsides, hypothetically, if you hit 20% in 2023 and 2024, and then you scale down 18%, then 16, then 14, then 12, then 10, then 8% in 2030, you only finish 2030 with 5.68 billion of revenue. I mean, that is a much different case than my original projection. And even if 2022 is an anomaly, I can make a case for them being at 10.2 billion of revenue, almost double. So I don't have enough information right now to make up my mind. I need to see where 2022 finishes, and I want to see what the first half of 2023 looks like before I decide what my exit price is and sell cover calls at that price. I'm not there yet. I don't have enough data, but the numbers are scary because I mean, I can see them either generating 2.1 billion of free cash flow in 2030, or I can see them generating 852 million at a 15% free cash flow margin. I mean, story's changed from it, really has.
Chris, go ahead.
No, I'm inclined to agree. I mean, there's definitely things that they need to start pulling some levers. I'll be honest, they need to start pulling some levers. The two levers that I think that are very available to them that for some reason they're not pulling is they're not creating a freemium tier product, because that will help them launch into hyper growth mode where everyone will be able to explore it. The few people that I've spoken to about what their hesitation on Palantir is that, and it's very simple. We can't try the product, so we're not even going to try to get them in the door. Like, I'm telling you, in the SaaS world, this whole like work in this cloak and shadow thing, it's not going to work. They're going to need to adopt a freemium tier that people can use, that people can try, and they're also going to need a developer community, like people that are entrenched in their companies, willing and able to put their neck on the line to say, hey, let's get Palantir, right? So those two things are the main like things that are holding it back. Now, where are some of the positives that I see? Number one, the government side. I see a lot of major projects that they're working on that, they're still bidding on contracts and everything else. And now with kind of like the House and Senate likely to flip to Republican red, I think that could help boost Palantir's presence in the Pentagon, and they might end up getting more contracts. But that's very hypothetical. I would not rely on that for any sort of measure when it comes to growth targets.
Can I ask your question?
Yeah,
Chris, it has to do with what you just said. I really like both your opinions. How important is the IL-6 to you guys, and how much value do you think that adds?
I think it depends. I think it depends on where. I think it depends on the government's need for more specialized tools when it comes to their classified networks. They're actually heavily investing in that regard. Like IL-6 is very important because access to classified and top secret classified networks is very rare to get that. But it also means that there's a lot less business need for it too. Like the processes that they have, the government fundamentally tries to keep very closed loop. So to get that, it does benefit them, but I think too many people are overly optimistic on the total value that can be generated off of it. You're not gonna see like $10 billion coming from the US government anytime soon.
But Karp did say in the letter that they're the incumbent now, not the insurgent when it comes to governmental. Like,
you can say all you want.
He's not just saying that to say that. I don't think he's saying that to say that.
I mean, look, if you want an incumbent in this space, look at Leidos, right? Look at SAIC. Those the two are the incumbents in terms of providing software to the government. Look at their market caps. What do you see? And they're generating way more revenue than Palantir is, Okay. So I probably wouldn't rely on that. And the government revenue is always lumpy too. So it's government wants you to do everything and do it for the lowest price. You ever heard of that, Amit, before? The government is
Yes.
all about the lowest bidder, right? Producing things at the lowest bidder. So Palantir, unfortunately, is not exactly going to get high margin revenue from the government. In terms of total revenue, they'll be fine. But yeah, I'm not going to talk too much about that further. But that is definitely one area where they could be some revenue growth. I'm not sure if it's a profitable revenue growth. Like when you work with companies, most of them have high margins. The government, they're going to want you to do everything under the sun, provide all sorts of additional services, and then they'll pay you whenever they feel like it, rather than living up to living up to their
So let me ask this or you this, let me rephrase it.
Mhm.
Do you think this makes Palantir more attractive as an acquisition target to a bigger company?
Oh yeah, hell yeah. I if they if they didn't have the F class shares,
There's
they would
one,
actually.
well, there's two specific companies I'm thinking of, and
Yeah.
I don't want it to happen. But I
It's
got two.
Oracle. Oracle's been kicking the tires for like the longest time. I mean, they would have taken them out years ago. Think about all the time.
It's not who I was thinking.
No, be surprised by that.
IBM.
I thought you were going to say
Mm,
Salesforce.
And well, so then you lost my second, but I think IBM, because they're consulting, because of their cloud, and there's no way that they are going to be able to, I shouldn't say no way, but I mean, when you think about how big AWS, Azure, and Google Cloud is, IBM, I think they're number 5 right now. It makes sense from a consulting standpoint and getting themselves in the door further with government, but
I don't know. I don't see them fitting into their ecosystem like that. I think Oracle would be the better one. Oracle is trying to do a lot of catching up. Snowflake is basically eating their lunch when it comes to databases and all these other things. So I think out of all of them, I think Oracle would probably be better. And Oracle has made a pass in the past, right? It's
Have
not
they?
like, yeah, huh?
I didn't know that they did.
Yeah. Ellison offered $30 billion to Teal in 2017.
Did
Said,
not
let me
know
buy
that.
you out. And Teal said, no, go kick rocks. There
But
was actually a
Teal's
there was
good
actually
friends
a
with them, though,
lawsuit.
right?
There was, yeah. But there was a lawsuit too, because there was a large shareholder of Palantir before they IPO'd who felt that they should have, like Palantir should have taken that offer. And he actually sued Palantir, being a shareholder, saying that you weren't doing right by what do you call it? The company, by not selling out. So yeah. I'm surprised you didn't know that, Steven. I'll send it to you. I'll send you.
No, if you could send me the link, I'd like to read it. I started listening to The Contrarian. I never read that book, so I downloaded it on Audible. It's actually pretty interesting.
Okay.
So, Matt, what did you think of the quarter?
Yeah, I felt the same concerns as you, Stephen. First of all, top level 478 million in the macro headwinds that we're getting. I thought that was good. Not even if not amazing, I give it up to a company to be able to do that. Given everything that's going on. Number 2, I agree with you. Customer count was amazing, seeing that grow up. Number 3, and this is what I hated in the last call, when Karp said we won't be profitable till 2025. I don't know how you felt when he dropped that bomb, but when he said that, I was just like, what? That came out of nowhere. And then same thing this time. This margin going down to 17%. That also kind of, we're not going to get 30% growth year over year, even if we hit 503 million in revenue, which is guidance. So unless they're massively sandbagging, if we hit basic guidance, we're going to grow at 22%, which means to CAGR at 30, one of these years has to be 38% at least. And I don't know. It's going to be a little bit complicated. Now, granted, FoundryCon renewed a lot of my trust and confidence in like the fact that this is a real product and they're figuring out how to bring it to market. Obviously, talking to CodeStrap and his delight over the technology being so advanced also gives me a bit of reassurance. But the numbers weren't amazing, but they weren't horrible either, which is why I don't think the market can see these numbers and say, okay, we're going to drop them 11% today. And so the reason I think they dropped today is really because of the macro.
I'm not concerned about the 11% drop. I think it wasn't enough to exit, but it wasn't enough to get excited.
Exactly.
And it's a waiting.
Yeah, I think the smartest move now is just a dollar cost average into the position. Don't get,
yeah.
yeah. But here's the one thing that I would say is when it does go above probably the 10s, 11s on overhypeness, just cut back on your dollar cost, just stop, give yourself a break. If anything, start selling some puts at a lower price, because this is very, this is not a tomorrow exponential growth curve story. This is going to take time, especially under this macro environment, unless they launch a new product that gets market adoption like crazy. I mean, and that is what Coach Strap was telling me about when it comes to Apollo, where Apollo could actually be scaled up very quickly. It could be a standalone product, and it could be Palantir's Model 3, right? If you look at it, when Model 3 launched, everyone in the mother was super hyped in the Tesla side because it was much more mass market and widely available. So that's what I would assume with regards to Apollo. Apollo has so many utilization cases outside of just the Foundry product, even though the purpose of Apollo was research to deploy Foundry and Gotham. I think that they ended up inventing something that could work everywhere. You ever like, it's almost like you made something different that's a much more marketable product, right? So that actually, and what's funny is that Coach Trap actually said it could have a larger TAM than the other two products, which are Foundry and Gotham, which, like I said, I'm still trying to understand it, to be honest with you. I don't think anyone really 100% understands it without utilizing the product itself. So I think if they really launched a product, they had an independent sales team that went out there and showed business use case and value for it, it could be another growth driver, which, by the way, Stephen, that could boost them back up above that 30% growth thing again. New products, and especially if it's really good and sensationally, like, I mean, exponentially like better than the current the current way of doing things, like I said, could end up being a revenue driver for them in the future.
When we talk about the three feared letters,
ICE?
No, SEC.
ICE.
SBC.
Oh,
B.
SBC. Okay.
So
I
SBC
believe-
went down from 180 million to 140 million, which is not
Yeah.
bad, right?
So,
It's almost a
but
20%
hold on.
reduction.
Hold on. Year to
That's
date,
about it.
we've still spent 435 million on stock-based compensation.
That is true. That is
Now,
true.
look, it's a double-edged sword, and normally I'm against stock-based compensation because it dilutes shareholders and it is an equity killer. But this is not Coca-Cola. This is a growth company, and I would much rather them issue stock-based comp than tap the debt market, especially in this environment. It's a double-edged sword. The problem I have with the number, and yes, year over year, first 3 months, it's down 28.7%, and Q3 year over year, it's down 24%, 184 to 140 million. I get that. The problem is we don't know how it's being allocated. We see it as a line item being allocated to R&D or sales or general admin costs, but we don't know how it's actually being used. And when I see 140 million being spent on stock-based compensation and the revenue growth rate going down and the net dollar retention not changing, I have a problem with that, because you're rewarding people, and I get it. They are competing with Google, Microsoft, and every SaaS company that has a huge war chest that they don't necessarily have for talent. They're competing with every company for quality salespeople. So I get it. They don't have the war chest that some of these other companies have, and they have to use that as a carrot to retain top tier talent. But at the same time, if the top tier talent isn't delivering, and these numbers are not on an incline, yet they're on a decline, there's a problem there. And if they're going to issue stock-based compensation like this, there's got to be a reason to do it, and it has to reflect in the numbers for shareholders.
Yeah, I would agree. I would agree.
My thing is, how much of it is executive comp versus actual shareholder, like employees? Like at the end of the day,
I'm sure it'll be in the annual report when it comes out.
we could take a look.
I mean, trust me, I'm going to be reading the whole thing and scanning the PDF for certain terms, and that's something I want to see. How much is going to C level? How much is going to the actual sales team?
Mhm.
One thing that's about to start happening is a lot of selling of shares for RSUs. So that's going to happen by the end of December. So that is,
You know,
put
that's
some
all
pressure.
vesting and everything else. So that's, can't go by
Yeah.
that. Can't go by
Yeah.
that. I'm not concerned about it.
All right. Well, so overall, it's not enough to get super excited, not enough to leave the stock. Need more data, probably a little bit of a DCA if you are a long-term holder, and you know, see what
No, I
happens.
stand by my comments in my article from last quarter that I need a year. And I think this quarter shows me that there are two paths it can go, and I need more data. I couldn't tell you which path it's going to take. I got no clue.
There's one thing that I think no one really talks about that we should probably talk about, and that's the opportunity elsewhere in the market, because there are so many good opportunities in the market that will limit people from investing in Palantir. Why? Because if Palantir is undervalued based on, like let's say everyone is doing well and Palantir is doing, phenomenally well, but it's undervalued because the stock price is down, then yes, we can look forward to institutional investors jumping in and buying more shares and everything else. There's a lot of money waiting on the sidelines for investment, and none of it. And as far as I can tell, with numbers like this, they're not really going to be looking to invest in Palantir. If anything, they'll look for other companies that have a much safer risk profile.
How about with
And
S&P down over 20%? People are just going to pile into ETFs probably. Just
yeah,
a regular index fund. I mean, at the end of the day, it's going to be interesting to see what the inflows on the Morningstar reports are going to be in the next couple of weeks.
yeah. So that will probably end up acting as a, I don't know, like gravity on Palantir. So I don't think we should be expecting $20-$30 price targets anytime soon.
Chris, let
Price
me ask
targets
you
should be
this.
meaningfully
There's-
lowered.
You had sent me those bonds to look at, and I looked at them. So what is your feeling on CD ladders right now? And this is where I start to get very worried about new capital coming in, because if you can build a CD ladder and get 4.7% on a 1-year CD and get around 3.7% on a 9-year, and this is before the next Fed hike, and we know that it's going to be around most likely 75 pips in December.
I'm getting 3.75 on my Robinhood Gold. Like,
So you start looking at building a CD ladder, how much money that's on the sideline ends up taking zero risk and locking their money up for 9 or 12 months and generating 3.7 to 4.7% at zero risk.
Yeah. Well, there's actually even better opportunities on the corporate side. There's corporate first lien debt, like a lot of, especially if you know where to look, first lien debt that you can get with very secured assets at probably 8 to 10% return. It's almost 3 times that, right? And because of the way that it's structured, you're, it's all secure. When I look to historically, first lien debt has on average gotten paid out 98 to 99% of all bankruptcies. Even in the most difficult bankruptcy situations of like 2016, when the oil patch had really gone south, all the first lien debtors, they all came out ahead, right? Second lien got wiped out about 50%. Unsecured, bro, they were done. Like barely they came with any, like they may have got like pennies on the dollar. But first lien debt is where I'd look right now, because first lien, a lot of companies that are going into the cycle of refinancing, if they had unsecured debt prior, what they could do is end up taking the loans for on their physical assets, whether that collateral, real estate, whatever, and end up reducing down their unsecured liabilities by getting them at a discount. But the first lien debtors would end up asking for really high coupon rates, right? So this way they can make up for it. So I think right now the biggest opportunities are, in my opinion, first lien credit. And especially with companies that specialize in it, like distressed situations. I told you about Oaktree before. Oaktree makes ton of return. I bet Buffett right now is out there just shopping, doing his thing. This is what Buffett does. He waits for opportunities like this to come and then just offers the most loan sharky terms to these major companies, and then either takes them out later or just puts in terms that sees him get freaking crazy amounts of return. And he's the only one that's able to do that because he's got more money than some of these banks. He's got more capital than the fucking banks.
Stephen, I do have a question for you as someone who's lived through some of these crashes before. Do you see this as like a time where the conventional wisdom says millionaires get made, right? The people who are willing to actually do the really hard thing, which is put their money in these companies? Or are you a little bit more conservative here and you don't think it's the time to invest? As we're talking about bonds.
Look, nobody has a crystal ball.
Yeah.
And looking at, and I don't like when people use the analogy that buy low, sell high. Yeah, of course, buy low, sell high, right? Greatest thing. It's very hard to actually pick stocks and know when to buy and when to get out. But, dollar cost averaging into an index fund has always, over the long period, done very well. And I think a lot of people are having distrust in the market, and more people are going to really take that advice instead of trying to hit home runs. And you're seeing it with the big tech. I don't think anybody thought Amazon would go under $1 trillion market cap.
Yeah.
I did not think Meta was going to do what it did. I mean, these were all the horses everybody was staking. So
Okay.
it can go two ways, but the landscape for 2023, I thought was going to be bullish, because when I looked at personally the top 100 holdings of SPY, and their earnings growth 2023 was higher than 2022 on the consensus estimate. I am not too bullish on 2023 right now overall, only because you look at what's happening. I don't think what's happening in the housing market has really ran through the economy yet, and I think that there could be some really hard times coming. But if that materializes, who knows? I mean, it's going to take time, but there are reasons for concern. I don't know what's going to happen, but I think if you're investing in index funds, that's one of the best things you could do. And if you're going to invest in individual equities, you need to definitely do your due diligence and have a very honest conversation with yourself and know what your risk tolerance is. A lot of people don't have that conversation. A lot of people just get caught in this trap of dollar cost averaging. It's eventually going to come back. Sometimes it doesn't come back, and people need to really think about what is that risk tolerance level.
Think of the people who are dollar cost averaging into Open Door, right? Open Door was down another 12% today.
Hold on.
Yeah.
So our buddy talked me into it, and after doing my due diligence, I'm a shareholder. I have not dollar cost average, but I was considering it. You look at the numbers. I mean,
It's going to go into a whole new debate. I don't know if we have time for that.
Chris, they have more cash on the books than the company's worth.
Chris thinks this company is going absolutely bankrupt, by the way, Stephen. So you're talking to a guy who thinks you're an absolute idiot for investing. He thinks you are a dumbass for investing in Open. Now, Chris is smiling because he actually does feel like the amount of times Chris has told me, Amid, anyone who invests in Open Door should walk out of an open door and fucking walk off a cliff. He has said this to me. He feels the same. All
right, so I have not looked at the numbers since they reported, to be honest with you. I just saw the headlines for revenue and EPS, and then it went down. So their cash position has gone down by about 900 million in the past 3 months.
Stephen, they're buying houses high, selling low.
But,
the company's going under. That's the point.
Hold on. They still have 1.5 billion in cash on the books, and their book value is 235. I mean, I don't know. I need to do some due diligence, but I
So,
don't,
so this is what I did, and I'll tell you, I have a program that does web scraping. Okay, so I web scraped all the housing that they owned in all their major areas, because one of the things that they have on their open
are
door
you not
platform.
using Tyler's software?
No, no,
Really?
I use my own software. I use my own software.
Not a plug for Tyler, but I gotta tell you, it's pretty nice.
Mhm. Well, I web
The way
scraped all
he
the
said,
data.
"Mm."
I web
Really?
scraped all the data. I looked at what the pricing was, what the actual value of it is, of a lot of these houses were, and then I ran models against the rise in interest rates and what the
Oh.
median income for each specific area is, right? So if you have an area that's worth, let's say the median income is $100,000 household median income, if it takes almost half that median income to buy it, that means that most of the buyers there are either just really stupid or they're cash buyers or something's up with it. One of the things is from an affordability standpoint, every time the Fed raises interest rates, the affordability gets worse and worse until prices go down. The thing is, their inventory overhang is what's killing them right now. There's so many areas where they've literally committed so much capital to it. The only thing that's saving grace for them is that, yes, they have cash, but look at how much debt they have also.
This is a bad
Luckily,
environment for them. There's no
yeah,
question about it. This is a complete spec, throw a dart at a board. If it hits, it hits. If it doesn't, whatever, for me
yeah,
personally. But I like the idea of the company because just like anything else, evolution doesn't stop. And
oh, yeah.
it could be, or the idea of what it is supposed to be, it could displace a lot of things in the industry. So I speculate on it for that reason, because it does make things logically simpler.
It
If
does,
that
but
translates to dollars and cents to the bottom line, it's a different story, and that's going to have to play out. And it depends how bad the housing market's going to be over the next year or so.
see, in a non-volatile environment, their business model works. They actually have contingencies built into their balance sheet to allow for fluctuations. Had the Fed not raised rates at the velocity that they had, they could have even adjusted, in which case they would have been fine. The problem, and this is where every business is taking a hit, is that the velocity of rate rises is killing everyone. Which CFO in January 2022 could have predicted that the Fed was going to go nuclear with raising interest rates? All
Nobody
their
would have thought this was going to happen.
exactly. So
Nobody.
every contingent dollar that you could have had in order to, mitigate any rate rises, no one would have said, okay, we would have get to like a 7-8% mortgage within 4 months. Like no one could have told you that. But
Do
guess
you
what? It
think rates are
happened.
going to 10%?
Oh, hell yeah, easily.
Patrick Bet David has been on the 10% kick
Yeah.
since at least spring or early summer.
Yeah,
And
me too.
everybody said he was crazy.
Me too.
You guys can end up being right. If
I
10%,
Wait, how can we do 10% if that would be like hundreds of billions on the trillions of debt? Like, do you think that's actually possible?
You're talking about mortgage is different thing.
Mortgage is
Oh, you're talking
different.
about more. Oh, I thought you said Fed funds. I'm sorry.
Yeah.
No. But yes, I'm starting to believe 10% could be a reality on mortgages.
And can you believe Dave Ramsey was telling people like, no, this is just a bump? Fuck him. David Ramsey's an idiot when it came to this
I've
kind of stuff.
actually never listened to him before.
Yeah. So,
Never-
but there is one thing that Patrick Bet David said that I think is interesting, that I think makes sense. He's like, right now is the perfect time to go out there and put out offers that are like, what's the word that he used?
Non-replicable assets.
No, not that. Not he said. Basically, if someone's put something out there for, let's say, $500,000, put it out there and just put an offer in for 400. See if they'll bite, because right now people are getting desperate. I forgot the word that he used for it, but basically, right now you should make egregious offers because you never know who's going to bite.
I'll send you guys a clip that he did, I want to say 2 months ago. It was phenomenal. I think he's one of the best when it comes to this type of stuff with the housing market, and just, he's a very interesting guy to listen to. And I try listening to his business stuff, not necessarily the interviews with non-business people, but whenever he does something on the business side, I always try to catch it. And he's been saying this for a long time, and he's been one of the few people that's been preaching it like you, and it may come true.
Yeah.
And if it does, 2023, regardless of what happens next week, I think it's going to be hard for the markets to rally. There was so you guys know who Joe Terranova is, right?
No.
He's a CNBC contributor. Do you guys watch The Compound at all?
No.
With Josh
Probably
Brown?
catch a clip. Oh, the
I know who
podcast. I've
Josh
seen it.
Brown
I've
is.
seen it. Yeah, I've seen the
Okay,
clips of it.
so Josh Brown and Michael Batnick do several podcasts. Fridays is The Compound and Friends. They had Joe Terranova on it, and he did a study about presidential cycles and what the markets do in it. And I guess I hate giving bad numbers. I don't remember the exact numbers, but it was something like since 1940 or something like that.
Steven, I'm going to stop you there. Is that the clip where he says that after every midterm where the incumbent
I think I
party
sent
loses,
it to you, Chris.
yeah, the incumbent party loses control of the Senate and the House, it ends up being a really good year because there is what is that thing called? There's a gridlock, so that all this shit that usually the government does to fuck shit up doesn't happen. You know,
Is
Is that why
markets-
Elon said to vote Republican today?
Yeah, that's exactly why he said that. Yeah.
If you, I'll link it to the two of you. It's a 2.5 minute clip, and it is phenomenal. And he did all the studies, and the data shows that the sweet spot is going to be, I guess, the third week in November to May. And that's when the biggest rally in a presidential cycle happens. So if he's right, we should theoretically rally. But when he did the study, the rates certainly were not where they are today. So if that matters, who knows? I don't know. Going to be interesting how it unfolds.
All right, I think we got to end it there. That was a good hour of us. Steven, are you
Jesus
ready
Christ,
to
I was tired. I felt not cognitive. Now I'm ready to go. It's 11:43. I'm ready to go.
we
I'm
all
catching
appreciate you.
Catching a flight, early morning flight to New York, man. So I'm gonna
Yeah,
head
I
out.
called Chris last. I was like, Chris, we got to talk about Palantir. He was like, okay, fine. That's what we do now.
Yeah.
Chris
Chris,
was up early this morning with me.
I know you got out of the position we were both in. Are you interested in any other energy companies right now before we go? We could talk about it.
Not particularly. I haven't actually taken a look. There were some coal companies that I was actually taking a look at, you know, but right now I'm looking at the debt, just looking at debt right now for a lot of companies, because I think there's still opportunities in the debt market that people are not necessarily considering that's have much better safety profiles in this market. My portfolio, the best performers are all the debt that I bought. And I bought a lot of debt during the 2000 COVID crash. So literally it's just sitting and just generating money. So yeah. I do have to take a look at some energy plays though, you know, because I think energy is going to be higher for longer than most people expect. I think there was a concerted effort to take energy down by the Democrats, but it kind of backfired on them. And the reason why is because the Russia thing. I don't think anyone could have predicted Russia either. That's the other thing too, you know.
There's a lot of unknowns. I like pipelines as
MLPs, baby. MLPs.
unpopular as they are. Energy transfer is very interesting. They're the only one, to my knowledge, that has exporting facilities on the Gulf and East Coast. And
Steven, I'm already sold on it. Speak logic to Amit so he understands that there's more to the world out there than big tech.
all right, so real quick,
I do have to go though. I'll see you guys later. All right.
See you, Chris. Thank you, man.
see you later, Chris. So as far as pipeline companies, I love pipelines because you have an asset that has the largest barriers to entry, arguably.
Right.
When you look at it, we need pipelines and we
Yep.
need storage. For the lights to go on, we need these assets. We need the energy infrastructure. The amount of red tape with getting permits, the amount of red tape with zoning, is incredible. You can't just raise $20 billion and create a SaaS company and try to go to market. With energy infrastructure, the amount of companies that are in the space are the amount of companies there's going to be. You can't just enter the space. And these are companies that Berkshire bought 7,700 miles of natural gas pipeline from Dominion Energy back in sometime in 2020. I think he paid 1.27 million per mile of pipe. This is Berkshire Hathaway. They have a huge energy portfolio. If it was feasible to build the pipelines from scratch, they would have just done it. They had the political clout, they got the capital, they acquired assets. I think pipelines are huge. The EIA projects that oil and gas will still be the largest energy sources in 2050. And these MLPs have been beaten up and they generate large amounts of distributable cash to their shareholders. It's very interesting. And Energy Transfer is huge in exporting. You look what's going on overseas. The world needs more American LNG, and Energy Transfer has 3 export facilities. The Lake Charles facility, they are changing from an import to an export facility. I think they've already sold, I want to say 30 or 40% of the capacity from that facility. Final investment decision will be made sometime next year, I believe. And they are, to my knowledge, they have the most mileage of pipelines in America out of any energy infrastructure company.
But it's not like you can expect major returns from these though, but like safe kind of 10, 20, 30%.
Safe. A lot of people feel that they've gotten scorned with Energy Transfer. If you look at a long-term chart, I look at them as an undervalued asset because of how the peer group trades. When you look at their distributable cash flow and their EBITDA, I mean, I think they did 88 billion in the TTM in revenue. I don't have the numbers in front of me, but they are a behemoth. And with the population still on track to grow from, call it 7.9 billion now to 10 billion by 2057, we need more energy. We are going to need more fuels. And natural gas and oil are the #1 feedstocks in plastics and in many other things, fertilizer for natural gas. And these touch so many parts of our lives. They're huge in manufacturing. It's not just filling up a car. It's not just turning on the lights. And they're going to be part of our lives. So I think that these are interesting plays right now due to the valuations and where they are, and the fact that you can't just go raise money and compete. This isn't SaaS. This isn't a food company. This is a industry where the barriers to entry are arguably the most out of any other industry. And there is tremendous value in that, because what would happen if these energy companies just stop transporting energy tomorrow? Think about the chaos. Think about the chaos that would cause if nothing worked.
The world falls apart. Yeah.
So I love Palantir, but I am very diversified. Some would say over diversified. But yeah, I think Energy Transfer is very interesting there, and it's paying a 7% dividend.
Is there any specific ticker symbol?
ET.
ET, and is that an ETF for energy, or that's an actual?
No, that's just Energy Transfer. That's my favorite right now. I think Enbridge, ENB, is probably, many would consider them, or Enterprise Product Partners, EPD, the gold standards. Enbridge is attractive because they're the triple threat. They actually own a natural gas utility in Canada. I think it has 1.3 million customers. They have a huge pipeline business. I want to say 60 or 70,000 miles of pipes. And they have a huge renewable portfolio. I think it's like 7 or 8 billion worth of assets in it. Huge wind projects, solar projects. They're the triple threat. And their dividend has been increased for 2 or 3 decades, year over year.
What's the, oh, wow. So there's an 8% dividend on ET, 8.5. And so did you load up in 2020 when energy crashed?
I have been buying here and there, and I'm a shareholder of ET. I own some EPD and some Enbridge. I like them a lot, but I think my own opinion is that ET is very interestingly valued right now based on where the peer group trades.
Right. Right.
And, they have ETFs for it, so you can get all of them.
Right. Okay. Sounds good. Thank you, Stephen, for taking an hour of your life at night, more than an hour at this point. Giving us that sweet content. I'm sure people will appreciate it tomorrow as we dissect Palantir earnings.
So, SoFi or Palantir, which one are you more bullish?
Palantir any day of the week. SoFi is cool, but Palantir.
Now,
Steven, we're talking about a Peter Thiel generational. We're talking about something big.
I'm a little surprised, to be honest with you. I love both companies. I'm a little surprised it was that quick of an answer. It wasn't even.
1000%.
It wasn't even a question. Like, you just answered it like I'm crazy. That
Because
one thing
digital banking compared to creating entire softwares that transform industries and verticals and protect the Western Hemisphere and freedom, like there's so much depth to this company, and I think we're just in the beginning. We haven't seen anything yet, and I think it's a quarter, like a Tesla 2018 Q2. It's like it's whatever. We got to give them some time. They'll figure it out.
and I've said it before, if you're in this for the short term, it's not the right stock. This is something where you need to be a long-term investor because it needs time to mature and play out. It may not play out,
Yeah. Yep.
but you got to give it years and years. That's why I always
Agreed.
said 2030 is where I'm looking for this.
Yeah. Either it's going to be 8 wasted years of that capital, or it's going to be some of the best capital I've ever put in. So we'll see.
You worried about the stock based?
No. I mean, look, I think that they put up a decent amount of money for this quarter. I think they have the best talent in the world. They're hiring. That means they have, like, a company's not hiring. They're not hoarding engineers like Meta hiring 84,000 people. They have business. They need to hire people to deal with the business. So they got to give them some stock. It's like, all right, whatever. Decreased 28% year over year. The one thing they didn't note, I noticed they didn't put in their appendix is the gap operating margins. Like, remember we went from -14 to -9. I think it stayed flat at 9 from the numbers I saw in the AQ. I don't think they increased or decreased, which is actually good for us, the gap operating margin. It's nowhere in the financials, or at least on the presentation. That does annoy me. This little secrecy, these hide some numbers, don't show some numbers. I get they have to present it to Wall Street. And I don't like the earnings calls of them not actually answering questions. That also annoys me. I was happy I was able to see them for once instead of it just be audio, but they'll figure it out. I have faith.
Harp didn't bang on any tables.
He didn't. I think he has like 17,000 of those little white shirts. Because every time I see this guy, he's in a white shirt and he's just being Carp.
Look, I like it. He's trying to be just a normal guy, which I respect. I'm very happy that he got some PR lessons and he didn't say anything to make anybody scared about doing business with them this quarter.
I agree.
Big plus on the PR front.
I agree.
All right.
All right, Steven. This was good stuff. Thank you so much for giving us some wisdom, and we'll talk very soon.
Sounds good.
All right. Have a good night.
All right, later.